Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Archer-Daniels-Midland Company annual report. Archer-Daniels-Midland Company offers a wide range of businesses and services across various sectors. At its core, the company engages in the procurement, transportation, storage, processing, and merchandising of agricultural commodities, ingredients, flavors, and solutions. The company operates in three main segments: ag services and oilseeds, carbohydrate solutions, and nutrition. Within these segments, Archer-Daniels-Midland provides a diverse array of products and services, including soybean meal and oil, vegetable and salad oils, protein meals, ingredients for food, feed, energy, and industrial customers, margarine, shortening, and other food products. In addition to its core business, the company also offers various specialty food and feed ingredients such as proteins, natural flavors, flavor systems, natural colors, emulsifiers, soluble fiber, polyols, hydrocolloids, probiotics, prebiotics, postbiotics, enzymes, and botanical extracts. The company also provides edible beans, formula feeds, animal health and nutrition products, contract and private label pet treats, and food products. Furthermore, Archer-Daniels-Midland offers financial services such as futures commission merchant, commodity brokerage, cash margins, securities pledged to commodity exchange clearinghouse, and cash pledged as security under certain insurance arrangements. The company operates globally with a presence in the United States, Switzerland, the Cayman Islands, Brazil, Mexico, Canada, the United Kingdom, and internationally. The significant increase in Archer-Daniels-Midland Co.'s ADM stock price over the past year can be attributed to several key factors. Firstly, strong demand within the agricultural sector and strategic expansion initiatives have boosted the company's performance. Additionally, ADM's management has made notable progress through cost reductions and improved plant efficiency, signaling operational strength and future profitability. The company's commitment to returning value to shareholders has also been a major contributor to its success. Archer-Daniels-Midland has maintained a consistent dividend growth policy for 53 consecutive years, with a recent increase announced in February 2026. This has attracted and retained investors seeking stable returns. Furthermore, the company's ability to manage profitability was demonstrated by its strong fourth quarter 2025 adjusted earnings per share (EPS) of $0.87, surpassing analyst expectations. The resolution of regulatory investigations, including a $40 million SEC civil penalty and the closure of the Department of Justice's criminal investigation, has also removed a significant source of uncertainty and overhang for the stock. Finally, positive analyst sentiment has played a role in driving up the company's stock price. Analysts such as BMO Capital have adjusted their price targets upwards, increasing investor confidence and influencing market perception. Overall, these factors have combined to drive Archer-Daniels-Midland Co.'s stock price increase of over 53.47% in the past year. Archer-Daniels-Midland Company market capitalization of $33 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Archer-Daniels-Midland Company holds a significant advantage in their industry. Archer-Daniels-Midland Company trades at a higher price-to-earnings ratio of 31 times and a higher price-to-book ratio of 1.46 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 58% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The company have a dividend yield of 3.03%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for Wilmer can be attributed to several key factors. Market fluctuations in agricultural commodities have a significant impact on the company's revenue, as do foreign currency, exchange rates, and volatility in freight markets. Additionally, counterparty contract defaults and the correlation between exchange-traded commodities futures and underlying commodities also play a crucial role. In terms of segment-wise performance, the Ag Services and Oilseeds segment has shown revenue growth, while the Carbohydrate Solutions segment has experienced a decline. The Nutrition segment has also seen revenue growth. Geographically, some regions such as Brazil have shown increases in revenue, while others like Mexico and the Cayman Islands have experienced declines. Furthermore, the company's total receivables sold and cash collections from customers on receivables sold provide insight into its financial performance. However, it is essential to consider other factors such as revenue growth rate and projected EBITDA margins when evaluating the primary drivers of revenue growth or decline for Wilmer. The net income of the company experienced a significant decline over the two-year period from 2023 to 2025. In 2023, the net income was $674 million, which decreased to $425 million in 2024, and further dropped to $1.078 billion in 2025. This represents a total decrease of $722 million from 2024 to 2025. The profit margins also saw a substantial decline during this period. The net earnings margin decreased from 100% to 49%, while the adjusted EBITDA margin fell from 104% to 81%. Additionally, the total segment operating profit margin dropped from 105% to 78%. These decreases in profit margins indicate that the company's ability to generate profits has been compromised. The gross profit margin and operating profit margin also experienced a decline. The gross profit margin decreased from 6.7% in 2024 to 6.3% in 2025, while the operating profit margin dropped from 2.6% in 2024 to 1.6% in 2025. These decreases suggest that the company's operational efficiency and profitability have been impacted. The reasons behind these changes are not explicitly stated in the provided text. However, it is clear that the company has faced significant challenges in maintaining its net income and profit margins over the past 2 years. The company's financial performance indicates a consistent trend of generating positive operating cash flow. The data from the past 3 years shows that net cash provided by operating activities has been consistently high. In 2025, the company generated $5.5 billion in positive operating cash flow, while in 2024 and 2023, it was $2.79 billion and $4.46 billion respectively. This trend suggests a strong ability to generate cash from its core operations, which is a key indicator of financial health. The company has experienced significant reductions in both its debt level and interest expenses over the past 2 years. According to the financial summaries, total debt decreased by $746 million from December 31, 2024 to December 31, 2025, with short-term debt decreasing by $1,105 million and long-term debt decreasing by $974 million. The decrease in debt level has also led to a substantial reduction in interest expenses. Interest expense decreased by $94 million to $612 million between 2023 and 2024, and further decreased by $35 million from 2024 to 2025. Overall, the company's efforts have resulted in significant reductions in both its debt level and interest expenses, indicating a positive trend in its financial health. The performance of various segments and regions in the company's operations has been mixed. On a positive note, the Nutrition segment saw an increase in revenue, with a 2% rise on page 30 and $118 and $117 increases in 2024 and 2023, respectively on page 60. The Ag Services and Oilseeds segment also performed well, with revenue growth of plus 8.5%, plus 10.3%, and plus 11.1% for Ag Services, crushing and refined products, and other respectively on page 59. In contrast, the emerging market areas, developed areas, and global economy all experienced poor performance on page 16. The Ag Services and Oilseeds segment also saw a decline in revenue, with a 7% decrease on page 30 and decreases of $2,364 and $2,310 in crushing and refined products and other revenue respectively on page 60. The Carbohydrate Solutions segment performed poorly overall, despite a plus 13.4% increase in starches and sweeteners revenue on page 59. The international operations also experienced poor performance on page 36. Furthermore, the nutrition segment saw declines in human nutrition and animal nutrition revenue of minus 10.3% and minus 12.5% respectively on page 59. The U.S. operations generated sufficient cash flows and had unused credit capacity of $5.1 billion on page 36. Overall, while some segments and regions performed well, others experienced significant declines in revenue. Management is optimistic about the company's outlook, citing opportunities for growth, operational improvements, and changes in the margin environment due to increased demand and policy changes. The company is positioning itself as a leader in business-driven sustainability efforts, developing new bio-based consumer and industrial solutions, and investing in entities and joint ventures to expand its market. Management is also focused on operational excellence, driving targeted cost reductions, improving manufacturing and production facilities, and increasing operating leverage. Additionally, the company is concerned about potential risks, such as disruptions in transportation services, raw material shortages, and changes in global trade policies. To mitigate these risks, management is prioritizing execution and cost management to drive long-term value, strategic simplification to optimize its portfolio and organizational structure, and targeted growth investment in key strategic initiatives. The company also expects to continue delivering strong cash flows from operations, driven by its diversified portfolio and focus on cost management. Management believes that the company's business will support lower carbon operations and the growing use of plant-based alternatives to fossil-derived materials. The company is investing in digital transformation and innovation to drive long-term growth and improve operational efficiency, and returning value to shareholders through share repurchases and dividend payments. Overall, management is focused on driving long-term value and sustainability efforts while navigating potential risks and challenges. The company's financial activities have been marked by a commitment to returning value to its shareholders. One key aspect of this is the payment of dividends, which has been a regular occurrence. The company has indeed paid out dividends in various amounts, as documented on pages 37 and 48 of the report. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows the company to reduce its outstanding share count and potentially boost earnings per share for existing shareholders. The company's share buyback activities are detailed on pages 24, 96, and 47 of the report, highlighting a deliberate effort to manage its capital structure and reward investors. Concerns about inventory buildup or supply chain disruption are evident throughout various sections of the report. On page 28, increased global supplies of grains and oilseeds, logistical challenges, and weather issues contribute to potential inventory buildup. Additionally, the Russia-Ukraine conflict escalations lead to farmer retention and logistical problems. On page 32, lower sales volumes due to decreased North American volumes and margins, as well as a temporary disruption at a key port facility in Brazil, further exacerbate concerns about supply chain disruptions. Higher manufacturing costs in North America and EMEA also contribute to the issue. The report highlights negative inventory valuation adjustments on page 33, crop quality issues in EMEA, and higher raw material costs in specialty ingredients subsegment. These factors all point to potential inventory buildup or supply chain disruption. However, it's worth noting that changes in inventories resulted in a cash inflow of $1.5 billion in 2025 due to lower commodity pricing and reductions driven by working capital reduction initiatives, page 36. Furthermore, the total inventories decreased from $11,572 million to $10,369 million between certain periods, page 52. Despite these efforts, inventory buildup is mentioned as a concern on page 62. The report also shows that inventory carried at market value increased from $2,713 million opening to $3,185 million closing in 2025, page 65. These mixed signals suggest ongoing concerns about inventory levels and supply chain disruptions. That concludes the financial summary for Archer-Daniels-Midland Company. Feel free to comment below, and I will be happy to answer them when possible.